Hello and welcome to this week's edition of FMR Finance Weekly, specially curated for our esteemed NRI viewers. We recently posted a couple of videos in collaboration with Dr. Garg from NRI Money Clinic. One of these videos focused on how to reduce withholding tax for NRIs planning to sell property in India, and it received a tremendous response on both the NRI Money Clinic YouTube channel and our Filemyreturn channel. We are delighted to see so many NRIs reaching out with queries and seeking assistance in applying for a lower TDS certificate. Your appreciation and positive feedback have been incredibly heartening. So this week, we are dedicating our segment to answering the top 10 FAQs we received from NRIs planning to sell property in India. I am Chaitnya, your tax advisor, making finance friendly.
FMR Finance Weekly. Simplify your life with our financial advice.
So without delay, let's dive into today's segment by addressing the first question. For an under construction property, should the date of purchase be considered from the date of registration, the original purchase date, or the allotment date? Well, this is the most frequently asked question by NRIs as to which date really counts for your under construction property. The Central Board of Direct Taxes (CBDT) has clarified that the allotment letter date would be considered to be the date of acquisition of the property. This is so because the allotment is final unless it is cancelled or the allottee withdraws from the scheme. But hang on, this date is key for determining if the property is subject to short-term or long-term capital gains. Short-term capital gains (STCG) tax rates apply if the property is sold within 2 years of its purchase date and is taxed as per your income tax slab rates. For long-term capital gains, that is LTCG tax, which is at 20%, the property must be sold after 2 years. For calculating the index cost of an under construction property for LTCG purposes, the index cost will be computed for each payment by considering the base inflation rate of the respective financial year in which the payments were made. Now on to the next question. What are the tax implications if I sell my property before registration? If you are curious or anxious about selling your property before registration, then there is no need to worry. The capital gain tax applies similarly to both registered and unregistered properties. The calculation involves deducting the cost of acquisition, home improvement cost, and transfer cost from the final sale price. The only difference lies in the cost of acquisition. For a registered property, you can include the registry cost, including stamp duty fees and court fees, increasing the acquisition cost slightly. So whether registered or not, the tax implications are computed the same way. Can the buyer transfer the TDS amount to me and I then pay the TDS on the property sale instead of the buyer? As an NRI seller, are you thinking of simplifying the TDS process by this manner? Unfortunately, the answer to your question is an absolute no. The buyer must deduct and deposit the TDS. There are numerous compliances the buyer needs to handle when buying property from an NRI. Firstly, the buyer should have a TAN number for deduction of TDS. TAN number is not required in case the property is purchased from a resident Indian, but is mandatory in case the property is purchased from a non-resident Indian. Only the buyer is required to have this TAN number and not the seller. In case the buyer does not have the TAN number, he should apply for the same before deduction of TDS. It is important to note here that in case there are two buyers, both of them would be required to apply for a TAN number. The TDS so deducted by the buyer shall be deposited with the Income Tax Department within 7 days from the end of the month in which the TDS has been deducted. For example, if the TDS is deducted in the month of June, then the TDS should be deposited with the Income Tax Department on or before 7th July. After the deposit of TDS, the buyer is required to furnish a TDS return. After the deposit of TDS and filing of TDS return, the buyer is also required to furnish Form 16A to the seller of property. Now for the fourth question. If my spouse and I jointly own a property Do we need to apply for 2 lower TDS certificates from the Income Tax Department? Well, joint ownership means joint responsibility for those certificates. For the property which is jointly owned by NRI, the lower TDS certificate will need to be applied separately for each owner for the proportion of property share owned by each. We routinely come across cases where the property is jointly held between husband and wife who are NRIs along with their parent who is a resident Indian. It is important to note that in such a case, lower TDS certificate needs to be applied only for the NRI couple separately for each and not for the resident Indian parent. Resident Indian will be subject to only 1% TDS. Dear viewers, here I would like to inform you about the wide range of services that are offered by FMR specifically tailored for NRIs to meet their diverse financial requirements in India. Our expertise lies in the areas of direct taxation beginning from income tax return filing, income tax notices, and litigation and scrutiny cases, income tax consultancy to new business incorporations, registrations, and related compliance services. You can connect with us on the numbers given below and in the description of the video. You may reach out via WhatsApp, email, or phone call, and we shall be glad to assist you. Now on to the fifth question. Are the 10%, 15% surcharge and the education cess applicable on the total sale value of the property or just on the capital gains? Ever been puzzled by those extra charges? For NRI property sales, the TDS is calculated on the total sale value, not just the capital gains. Additionally, the TDS has to be deducted along with the surcharge of 10 to 15% on the TDS amount, plus additional 4% health and education cess on both TDS and surcharge amount. The surcharge rate depends on the sale value of the property. Now for the sixth question. As a seafarer NRI, what happens if I don't repatriate the money from the property sale and offset the gains by investing it in the Indian capital market? For our seafarer NRIs, the rules are similar to other NRIs when it comes to selling property in India. The tenure of stay in international waters determines your NRI status, but your tax obligations remain unchanged. For instance, if the person spends more than 183 days in foreign territorial waters, they are considered an NRI. However, if they reside for a major part of the financial year in Indian territorial waters, they are considered Indian citizens. There is no change in the 20% withholding tax rate on the property sale value. So, your investment in Indian capital market will not aid in reducing the capital gain tax. Now, seventh question. What are the options to reduce the capital gains on property sale? Looking for ways to minimize your capital gain tax? Here's what you can do. First, determine if you have a short-term or a long-term capital gain. For short-term capital gain, you can set it off against a short-term capital loss, or you may pay tax as per your applicable income tax slab rates. For long-term capital gain, you have three options. Option 1. Offset LTCG against your existing short-term or long-term capital loss. Option 2. By investing in a new property being a residential property, maximum capping of 2 residential properties at a time. The proceeds can be reinvested only in a residential property and not a commercial property. The purchase of the new residential property should be done within 2 years, and in case of a construction of a new property, the time frame of 3 years is allowed. Option 3. Buying capital gain bonds. One can save on capital gains tax by investing the proceeds from the sale of the property in capital gains bonds. The maximum amount that one can invest in these bonds is Rs 50 lakhs, and it has a lock-in period of 5 years. The rate of interest offered is pretty low at approximately 6%, but the chances of these bonds defaulting is almost none as they are backed by government. Now for 8th question. Can I, as an NRI, gift my property to my father, who is an Indian citizen and also a co-owner of the property? So, are you planning to gift your property to your father? We address this question by posting a dedicated video for NRIs who are planning to receive or make a gift. This video has a lot of material and in-depth information on the topic of gifts. So please do watch the same. Link to this video is given above. Nevertheless, I'll try to address this question here as well. To answer this question, we first need to know the nature of the property that is proposed to be gifted. NRIs can gift only residential or commercial property, and that too can be gifted only to first a resident Indian, second to another NRI, third to a PIO, that is person of Indian origin. NRI, PIO or a foreign national holding an agricultural land or plantation property or farmhouse in India can gift the same only to a person resident in India and who is a citizen of India and not another non-resident Indian NRI or PIO. A foreign national of non-Indian origin would need prior approval of the RBI for such a transaction. Now, question 9. Is there a way to lower the TDS liability? Yes, absolutely. There is a way to lower the TDS liability legitimately within the bounds of defined income tax rules. So, you can approach us to assist you in the whole process. We shall apply on your behalf for a lower TDS certificate. The application is made online on the Traces portal. The International Ward Officer assesses the application along with the supporting documents submitted. Then, based on the merits of the case, the assessing officer awards the lower TDS certificate. So, if you are looking to apply for a lower TDS certificate, connect with us immediately on the numbers given below or at the end of the description of the video. Do reach out to us. We shall be glad to assist you. Now for the next question, question 10. What are the documents that are required to apply for a lower TDS certificate? Well, there are numerous documents that are required. First, we have to list the complete payment transaction details made to the builder or the party from whom the NRI had purchased the property. This should be supported by the payment receipts and payment ledger issued by the builder. Then we have to prepare computation of the indexed cost and the capital gain or loss statement along with the applicable tax outgo. Third is the builder buyer agreement and the conveyance deed. Fourth, we need to submit the complete KYC documents of the NRI like passport, OCI, visa copy, PAN card copy and Aadhaar card. Fifth, from the buyer's side, we need the PAN card, Aadhaar card and TAN number, which is absolutely mandatory, without which we can't apply for the lower TDS certificate. So that's it from my side. Let's recap today's video. We addressed the top 10 FAQs from our NRI viewers, which included: first, determining the purchase date for the capital gains for an under construction property. Second, tax implications of selling property before registration. Third, whether a buyer can transfer TDS to the seller for payment. Fourth, the need for separate lower TDS certificates for jointly owned properties. Fifth, applicability of surcharges and education cess on property sales. Sixth, impact of repatriating property sale proceeds for seafarer NRIs. Seventh, options to reduce capital gains tax on property sales. Eighth, the possibility of gifting properties to a resident Indian co-owner. Ninth, ways to lower TDS liability. And 10th, required documents for applying for a lower TDS certificate. I hope you got more clarity on your queries. For more personalized assistance or further clarifications, reach out to us on the numbers given in the description. Stay tuned for more insights on maximizing your financial opportunities. And don't forget to like, share and subscribe our YouTube channel Filemyreturn. I am Chaitnya Garg, your tax advisor, making finance friendly.
FMR Finance Weekly. Simplify your life with our financial advice.